up and away. Only, I think, one day of settling below the 20-day moving average.
Hi again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. I have Joe Camp of Comstock Investments with me today as we do our usual take on the markets at midweek. Well, today is a little extra special here, Joe, because tomorrow we have the Ag Outlook Forum kicking off in Arlington, Virginia. We should get some big numbers out of that group there. But in advance of that, it seemed like the grain markets, by and large, had kind of a rough day here on Wednesday. What's up?
Follow through from the weaker start to the week and the weaker finish to last week. This is what we have to, I think, start with to rewind to last week. The beginning of the week, all positive, particularly for corn futures. We were talking about finally that nearby March contract bumping back above $5 for the first time since last summer. And having a new high for the move really paint a friendly picture. And it was an extension of additional fund buying, that aggressive net long held on corn futures and options by managed money being bolstered further. But there were some signs of a potential pause that we had pointed out. We talked about these textbook cases of bearish divergence showing up on the charts. It had been the case in the previous week that developed for soybeans, where you poke to a new high and then you don't have the conviction showing by higher volume or new highs for some of those simple momentum studies, relative strength index or the MACD, for example. Then corn took a turn on that last week, making those new highs, but not seeing the real bullish conviction confirm. And it only took Friday and the pervasive negative sentiment spilling over from outside financial markets to really send those speculators rushing for the exits. And we had observed the Dow Jones, for example, down almost 750 points. You have a response to a negative consumer sentiment report, some weaker data on housing, all of the then weekend negativity over tariffs and what that might mean for the economy as a whole. And it continued here into this week. And so it continues to be the theme for me of one of liquidation and these speculators stepping out of the market, as opposed to them necessarily reversing positions and looking bearish to any real degree. But it's a wait and see mode now. It's let's let the dust settle, get out, not be the last one to sell, and then let's see what the next fundamental input would be. And that brings up, as you mentioned, the Ag Outlook Forum.
Now, what is your clue for believing that? The open interest getting smaller or what?
Yeah, that can be part of it, where you see these little spikes in volume, but declining open interest to indicate liquidation over new positions being taken. And then, back to those momentum studies where you could signal this slowdown in the types of sizes of moves on the up days becoming smaller. That signals some of that slowdown of fresh buying, at least, and then ultimately a turn towards stepping out of the market and position squaring. And that can occur not only because of the headlines or what we're seeing on the charts, but because of the time of the year, or in this case, the time of the month, being that we're going to be out of February now in just 2 days. With that comes the delivery period opening up for March futures. And that's a big component as well, the mechanics of these decisions and whether or not the fund traders, who by and large are going to be bunched into the nearby contracts, are they wanting to move their length into the later deferred contracts or not? And most indications are that they have not wanted to, at least for now, swing those bets out a lot further.
So anybody that doesn't want to be delivered on, they have to be out by the end of tomorrow?
That's right. Yeah, the in this case, Thursday before first notice on Friday would be the day for the longs to cover these positions. And that brings up this decision that would not only have to be made by speculators in carrying their position forward and how to achieve that, but on commercial buyers and farmer hedgers too. For the commercial buyers, this widening of the spreads from March to May and the carry premium that was built out into the May was a bearish signal. And for that occurring, by the way, as we had that waning momentum, even with new highs being poked out, was a bit of a bearish foreshadowing as well, that bear spread. And we had a conversation about that last time, what the bear spread meant for the fact that the further out contracts were holding up better than this nearby. Well, the wider spread is also a suggestion of the end users, the buyers, the exporters, the elevators, merchandisers, not having to really scramble for coverage so that they can execute against the March. Instead, we know that they've bought a lot of corn here lately, definitely in January, which is usually one of the top months for sales. Definitely when prices are rising, as they have quite considerably. We're still talking about farmers having taken advantage of a $1.35 plus from the August 26 low. And so now we're not seeing, at least for the time being, a real need to get out there and for the grain buyers to really push for making additional purchases, again, at least for now.
Even though May corn really didn't change too much Wednesday on the chart, I mean, it has just obliterated that uptrend line, hasn't it?
Yeah, and that's going to be key when you look at this rise up from the late August low that I talked about. We had been, up and away, only I think one day of settling below the 20-day moving average. Now after Friday's break, it's three in a row, and some semblance of support. I watched the Bollinger Bands, for example, a measure of volatility with a couple of standard deviations away from the 20-day moving average, and that might be why we're seeing, at least on this side of it, then a slight slowdown in the selling pressure. So can we bounce from here, potentially back up to that 20-day moving average that I mentioned is up just a hair above $5, $5 now, turning from newfound support into resistance, and then marking out, if we do keep going back lower, some various downside targets. You get a whole lot lower than here, and then as you allude to, you've pretty well broken down below that uptrending channel that we've been in since August. And we'd have to potentially then bring into, this is a top of mind. I wrote the Friday Comstock report about the technical targets for corn in particular, but also soybeans as well. But for corn, what really stood out is if you talk about Fibonacci retracement targets, you get to that first 38.2% retracement, and that's almost right on $4.50. So I talk about $5, and we know that that's a psychologically important mark. Well, so are the quarter marks, and 450 would be the next one. If we could go down, it'd be a pretty sizable correction still. We're talking about 25 cents plus for the nearby contract. That could still hold us overall into what can be a bullish secondary trend that we're in right now, flipping towards long term, maybe a more bullish primary trend. But on the other hand, if we give up 450, I think we're in trouble technically, and that means there's more breaking down, and there is probably at that point quite a bit of new selling interest in the market from speculators, as opposed to, again, what we're talking about right now, which is still mostly just liquidation of the longs.
Looking at the soybean daily chart on the May contract, it looks like a couple of blackbirds sitting on a wire. I mean, it's just perched right on the 50-day moving average. Hasn't broken through it, but it just sits there right on it. And actually, the 100-day moving average is just right below that as well. They're both kind of critical.
Yeah, absolutely. And you've got this broader narrowing wedge that we've been in. If you mark out this little interim high from late last fall, and then the low that we had marked out just recently in mid-December, we've traded within those ranges now since then, and even on this last little leg up through most of January and the first part of February, that could be another little narrowing formation that it seemed as if because these funds were on the gas pedal from the long side for a while, that could be a formation that we could break out of from the top side. But now that we see this waning momentum and the failure to gain any traction here, it's right back into play where you talk about these old lows for the market. And first up, $10, not too far away for the nearby March contract. That's going into delivery here at the end of the week, leaves up the May to be our next prompt month at 1041. But the way this market moves, it's not far from being out of the double digit tens and back into a 9 handle potentially.
And on the wheat, it looks like Kansas City and Chicago May wheat, both of them have come down and they both just hit the 50% retracement today.
Yeah, I mean, there you go. Not very long above what we wondered would be new support at $6, and so that turns into a pretty critical topside limit. And before then, you mentioned some of the retracement. We're maybe roughly holding the uptrend that we've been in since the start of the year, early January, but having lost now that 20-day, just splitting the most recent range, we've got resistance that's pretty clear up into that little bunch of highs and lows that were centered around that $6 mark. So, similar to corn or soybeans, like we mentioned, these even money marks, $4.50 for corn, $10 for soybeans. It's now down for May Chicago wheat, $5.50 next test.
Well, let's move on and take a look at our livestock trade here on a Wednesday. As you look at live cattle, I saw some negative signs there. Feeder cattle, mainly in the red. Hogs had a pretty decent day on lean hogs. Let's start with the cattle here. Where are we anyway in support and resistance on the cattle?
So cattle futures, you talk about big support turn resistance at 200 and that noteworthy mark having been given up there back on the last few days of January. We talk about this 20-day moving average broadly defining the trend. It's now pointing lower and has been for the last 10 days or so. We saw yesterday's move bring a couple of these most active live cattle contracts right up for a test of that, but then failing to gain any steam here today. After basically 3 up days, you get those chunks of threes and then a reversion like we observed here. So that leaves, in my mind, I look at April live cattle, the 20-day at just over 197. The lower end of the range is going to be right at that even 190 mark. So for what was a weaker close, I'd call that a more likely continuation of the current trend and a move towards 190. Now, 190 could very well be a important support factor because we could bring into that point where the board is back to trading relative to the cash index or the cash trade, which we have now observed probe just below 200, but nothing as far as 195 or 198, which we think should generally hold. So again, you head down to 190 in any type of a hurry, and that's probably a wide enough discount that we start to see some fundamental buying interest at that point.
I know on the feeder cattle market, you and I have talked in the past that it looked like maybe it was setting up a head and shoulders formation on it, but it kind of blew that out in the last 3 days, and it looks like it kind of destroyed that. However, on the live cattle side, one could kind of argue that that would still be in play.
Yep, and that's a similar conversation that we initially had for the hogs, and then they blew out to new highs, but yet that was only a couple of days lasting before an immediate turn back lower. And I think you just get these headlines that drive short-term bursts, and they go further and faster than you'd necessarily think. It's an increasingly volatile market, given the different headline points, but then the technicals can take back over. And in that sense, yeah, we could see live futures setting up that type of more bearish pattern that ultimately the feeders would turn into a follower on. We talk so much too about feeders having been the leader on this move. If we get a more negative break on the live cattle, which are going to be relatively the more actively traded contract from the speculators, and if that's an indication that recently the speculators, the funds at least, have whittled down their net long, then that would be the recipe for the feeder cattle next. The last reporting week, having built up, managed money did a new record net long in feeders, but they can erase that or pair it lower here pretty quickly if live cattle turn into the leader lower towards 190.
Hogs are an interesting lot, aren't they? It looked like they broke out of the bottom side of an uptrending channel, if that makes sense, here a couple of days ago. And then they had that big, I don't know if it was quite a reversal today, but a big bounce upward. I don't know what that all means now. Technically, when you look at that, it's kind of a mess right now.
Yeah, it is. We had that gap lower and then an extension of that, but prices falling quickly to what I would call possible support eyed at that lower Bollinger Band. If you're talking about the lower Bollinger Band, again, it's a volatile move. It has been 5 out of 6 days down for the hogs, and so you can see some bargain buying type of interest there, and then maybe a little further follow through when you look at these summer contracts, the June and later, perking back up above $100, which is a critical mark. You bring in that knee-jerk sell-off reaction and all of the technical ramifications, and you get those out of the way, and then maybe we can get back to down to earth and pricing in what we know to be all of a sudden less bearish, I'd say, cash inputs for the hogs, and that was with a really ugly slide in the cutout. Then all of a sudden that gaining some traction and holding up. Some optimism too that we're going to still have to work through the knowledge of tighter stocks, but pork in particular here, as would be reminded from the cold storage report out later on here. And beyond that, still the projections for numbers falling into at least the first half of the summer. That, like we're talking about with the headlines on cattle too, hogs not without their unfortunately own disease issues that leave barns less than full in areas, and that being something that can only exacerbate the pinch on supplies through the next several months. So what was a technical snowball type of sell-off that we can see become an over-exaggerated move, maybe finally a breather and a restoration of the fundamental dynamics that are more friendly here today for the hogs.
All right. Well, Joe, thanks for analyzing everything for us. Appreciate that. It's kind of a treacherous road here in the markets. Now, I can't wait to see what happens with the ag outlook for them. And we'll be talking about that and trying to get some analysis of those numbers after they come out too. It'll be very interesting to see what the market reaction is when the numbers come out. Joe Camp with us today. He is with Comstock Investments. That'll do it for this episode. Thanks again for joining us. For producer Brianne Jenkins, I'm Marlin Bohling. We'll catch you next time on the Comstock channel. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.